This is the Prime Pod. I'm Robert McLean. My guest today is Michal Stupavsky, investment strategist from the investment firm Conseq. Michal writes one of those must-read newsletters that I think you need to keep on top of. Michal, welcome.
Many thanks, Robert, for inviting me. It's a great honor to be on the show.
So I've started putting out newsletters as well. Is yours coming out every week then? I think it's on Mondays?
I'm doing my best to publish it every morning, and it's in Czech language, covering global macro themes, global macroeconomics, global financial markets, and of course my employer, my company, Conseq Investment Management, is publishing it on our webpage as well.
Okay. Is it fair to say there hasn't been a lack of things to write about in the past few weeks?
Definitely not. Really much. A lot has been happening. With that being said, during the last 2 weeks, market somehow calmed down because we have not heard during the last several days so many important announcements from the U.S. administration. So the volatility on global financial markets went down significantly. Now it's relatively calm, but we think it seems to be calm, but maybe before another storm might be coming in the upcoming weeks.
Okay, well, we're going to get to that, of course. I am curious because I've been meaning to, you haven't been on the Prime Pod in a while. What did you think was going to be the main story for 2025? I mean, what were your conclusions at the end of 2024? Where did you think the narrative, the economy had gone? And what were you expecting until, say, about a month ago?
Yes, so very important question. At the turn of 2024 and 2025, everything looked, I would say, just perfect. The global economy was growing quite decently, approximately at its structural supply side potential at around between 2.5% and 3%. Financial markets, the major asset classes, and in particular risky assets were priced, I believe, for perfection, especially U.S. equities, the large caps within S&P 500 index. And investors were expecting that the upcoming president, Donald Trump, will bring economy, market, and business-friendly policies, which unfortunately turned out not to be the case that much.
Right. Does that mean you were not one of the people who was, say, concerned about the dominance of the Magnificent Seven and the expensive-looking PE ratios? Where did you come down on that whole argument?
We have been communicating already for quite some time that especially these Magnificent Seven companies, Magnificent Seven stocks, their valuations were way too high.
Okay.
And we continue to believe that they are still high, despite the fact that Bloomberg Magnificent Seven index has declined by approximately 15% year to date since the beginning of the year. The key darling of investors during the last couple of years has been NVIDIA. And we have run several financial models on NVIDIA. And for example, taking stock of our reversed engineered discounted cash flow models, this model shows us that the current valuation market capitalization of NVIDIA approximately at the level of $2.5 trillion US, is pricing in a CAGR, compound annual growth rate of free cash flow or earnings for the next decade till 2035, 25% annually. So to put this message into a perspective, last year, 2024, free cash flow was around $60 billion. And the market, based on our reversed engineered DCF model, is pricing in that in 10 years, in 2035, free cash flow will be 10x of the current one, so between $600 and $700 billion annually free cash flow to firm, which is priced in a scenario which the probability of which it will be realized in the upcoming years is not that much high, in our opinion, and that's an indication that the stock is still somewhat overvalued.
Is it fair to say then that it's sort of towards the end of 2024, we were talking a lot about AI. There was a lot of excitement, at least on the U.S. side, that deregulation would lead to sort of further growth and maybe it could keep the party going, essentially. And that was sort of what I think a lot of investors were expecting going into 2025.
Yeah, definitely. The majority of investors were quite bullish on 2025, especially they were betting on continuation of this U.S. exceptionalism theme. However, it seems now that the 2nd of April, the Liberation Day, somehow marked the peak of U.S. exceptionalism, and what we have seen during 2 weeks after the Liberation Day was something really extraordinary, and by that I mean that at the same time all U.S. assets were significantly selling off, which means U.S. dollar, the currency, U.S. government bonds, U.S. treasuries, and also U.S. equities. So such a development did not happen during the last several years or many years. So many investors were really surprised, I think.
This was strange in that the dollar is falling and the yields on U.S. Treasuries were going up, which indicates fear, basically.
We think, and we've been communicating this since the end of 2024 to our clients, investors, and business partners, that we think that the world financial markets are gradually transitioning to a new global macro regime, which has in fact 3 key attributes. First of all is the all-time high record amount of debt in the global economy, in the global financial system. Based on the latest data from the Institute of International Finance at the end of 2024, there was approximately $318 trillion of debt in the world economy, accounting for all key economic agents, governments, corporations, and households. And this figure on the relative basis to the global GDP was approximately 330%. So literally, the world is now drowning in debt, which has negative consequences for the potential structural economic growth. That's the first attribute of the global macro regime. The second attribute, in our opinion, are structurally higher interest rates, policy rates of central banks and government bond yields and corporate bond yields as well, especially due to somewhat higher and sticky inflation, which at least in the United States will not be coming down to the 2% Fed's inflation target anytime soon. And in this regard, connected to that is significantly elevated macroeconomic volatility. Key macroeconomic variables are and will be much more volatile than in the 10, 15 years since the global financial crisis, when key central banks were carrying out huge amounts of quantitative easing. And last but not least, the third key attribute of the new global macro regime is extremely elevated geopolitical and economic uncertainty, driven by fairly to say, big military conflicts across the world, and now since the 2nd of April at least, these trade wars driven by the new U.S. administration. So in total, taking into account all three key attributes I've just mentioned, we think that investors in the upcoming years will have to be much more flexible, taking care, structuring, positioning their portfolios, and at the same time there are voices starting to appear that the traditional setup of 60-40 portfolio, 60% stocks, 40% bonds, might not be in the upcoming years the best investment solution. We at Conseq Investment Management have been recommending our clients to have at least some allocation to alternative asset classes like real estate, private equity, or private debt, venture debt, basically, as we think that the diversification will be needed now and in the upcoming year than ever.
Now, I called you up after your newsletter of about 10 days ago, in which you were writing that European stocks are on average, I think, 40% cheaper than U.S. stocks. Let's talk about like what you mean by that, how that's measured, and what the reasons for that were.
When I say European equities or non-US equities, we can include Asia, Latin America. When I say that, we usually, the investment professionals, work with price multiples, valuation multiples, such as PE ratio, which is a ratio price to earnings, which is a ratio of the current market price, share price, to earnings per share, corporate profitability per share. And you can, of course, you can use it for the whole equity indices as well. And there is not only P ratio, there is price to book ratio, EV to sales, EV to EBITDA, dividend yields, cyclically adjusted PE ratios, and many more. And on average, I'm following 6 major such valuation indicators, and they are showing me that at the moment, rest of the world equities, non-US equities, are on average 40% cheaper than the S&P 500. And we at Conseq do not think that such a still very high valuation premium of U.S. equities is justified, given the fact that during the recent months, at least on the relative basis, macroeconomic outlook for the U.S. economy has been deteriorating much more compared to the Europe or Asia.
But actually, let's focus on the European ones. Why are European ones less expensive than their American peers?
The thing is that since the global financial crisis in 2008 and 2009, U.S. equities broadly have been outperforming the rest of the world equities, including European equities, and this trend accelerated during COVID period, especially due to these Magnificent Seven companies whose corporate profitability has been significantly boosted by this AI narrative, AI, artificial intelligence trend, during the last several years. So to a significant extent, this outperformance of U.S. equities has been driven by much better, higher dynamics of corporate profitability, corporate earnings in the U.S. Of U.S. companies have been increasing much strongly. Nevertheless, having said that, also the PE ratios, the valuations increased significantly. So, for example, when you take a look at Robert Shiller's, the Nobel Prize laureate, cyclically adjusted PE ratio, which is publicly available free for download on Robert Shiller's page at Yale University. The time series started in somewhere at the end of the 19th century, and basically at the moment S&P 500 is trading at 33 times 10-year inflation-adjusted average earnings per share. To put this number into perspective, on the whole time series, this current value, 33 times earnings or PE ratio 33 means 96th percentile across the data, which is saying that only during 2% of the observations time periods valuations were higher, and this was especially during the dot-com bubble around 2000 and in the post-COVID rebound at the turn of 2022. Otherwise said, this very crucial and widely followed valuation indicator is indicating to investors that U.S. blue chip large cap companies within S&P 500 are still somewhat overvalued for a midterm investment horizon of the next 3 to 5 years.
I'm a journalist, so I deal in headlines, and that, to me, when I see that kind of a graph, I say that looks crazy expensive, and it's something that I think the DeepSeek moment back in January may have actually put a bit of a dent in that narrative that you were talking about. The fact that these huge successful companies that everybody thought could do no wrong and the future belonged to these AI companies, pouring billions and billions, hundreds of billions of investor money into these products like ChatGPT and Grok and God knows what else. And then all of a sudden this Chinese company with about 10 million and a couple of guys in a garage basically come and do the same thing. I would think the investors would be looking at of ChatGPT and these other ones would be looking and say, what have we been investing in? Was that maybe the beginning of this hissing sound, which is the air coming out of the market?
Well, we at Conseq think that this might be it. I've read like 1 or 2 months ago an excellent piece from the head of analyst team at Deutsche Bank, Jim Wright, and he was writing that in the past 2-3 centuries, all the major technological breakthroughs at the end of the day brought significant productivity gains for the economy. So for the economy as a whole, the effects on the margin were very, very positive. However, regarding the companies with the publicly quoted shares, which are bringing these new technologies to the market, to the economy, there has been very strong historical tendency that their share prices tended to be seriously overvalued due to this hype of new technology by investors. Basically, the thing is that at the moment or at the beginning of this year, U.S. information technology companies within a NASDAQ index, the whole IT sector, all shares or most of the shares were priced for perfection, that every company will be a winner. But from the probability distribution point of view, simple statistics,
Right.
common sense, this is not possible. One or two companies out of 10 in the sector might be the next winners, but the other 7-8 companies will be the losers who might not be even able to survive. But when the whole Nasdaq market, Nasdaq index was priced at, if I remember it correctly, 40 or between 40-45 times annual earnings, P ratio between 40 and 45 at the turn of 2024 and 2025. This is an indication that on average investors were believed that all the companies in the IT sector will be the next winner, which is not possible to happen. But in the current moment and during the last 2, 3, 4, maybe 5 years, this narrative, AI narrative, this IT narrative was extremely strong, and of course many investors have made a fortune on the stock market. That's fair to say.
And the founders have done pretty well as well.
Absolutely. But from the statistical point of view, simple arithmetics, common sense, not every company in a sector can be the next winner.
Right. Now, if we can circle back, though, to the question about the European stocks being cheaper, you were mentioning that because U.S. corporates were extremely successful. I'm curious, now that we've had this geopolitical sort of earthquake of Liberation Day, in which so far it's looking like the U.S. may have shot itself in the foot a bit. And on the other hand, though, you see Europe actually drawing potentially quite useful lessons from this shock. Germany has taken off the debt brake. Europe is potentially going to start investing in its own armament and various infrastructures. There's an opportunity potential, I think, in Europe, or at least that's a new narrative that's gaining strength. Where do you come down on that? Do you think there's potential for Europe at this point, or are you going to tell me that's actually a nice idea, but maybe there's a danger that it's more hype than reality?
We definitely think that on the horizon of the next 3 to 5 years, in our base case scenario, European equities should be outperforming U.S. equities by a decent margin, and in particular due to the valuation discount compression. So on the relative basis, we think that U.S. equity valuations should come down and European equities valuations should go up. We are not saying that they should be on exactly the same level, but in any case, some narrowing of this discount of European stocks should take place in the next couple of months and years.
Is that driven by a shift in the bias towards investments in the U.S.?
You have to take into account that at the moment foreign investors are still heavily exposed to U.S. financial markets. Foreign investors hold at the moment approximately 25% of U.S. financial assets, approximately $19 trillion of U.S. equities, $9 trillion of U.S. government bonds, and $7 trillion of U.S. corporate bonds, which means that the so-called NIIP, net international investment position of the U.S. economy is at minus 60% of the GDP, which is I think, all-time low, which means that if this trend of quite adverse or negative attitude of global foreign investors towards the U.S. economy, U.S. financial markets, U.S. administration will continue. These foreign investors just can sell their U.S. assets and bring it back home to Europe, to Asia, to Latin America, wherever. Having said that, we think that U.S. Financial assets, U.S. financial markets are still relatively vulnerable to the atmosphere, to the psychological setup of foreign investors. And also the taking into account the fact that U.S. government fiscal position is quite likely not sustainable in the midterm to long term. We also think that U.S. dollar might continue to be under pressure in the upcoming quarters and years. One more highlight on the U.S. fiscal position: U.S. government debt to GDP 125%. Very high. Germany is around 65%. Czech Republic around 45%, 1/3 approximately. Fiscal deficit to GDP in the US, 7% of the GDP. In the Czech Republic, it has been last year around 2.5% only, 1/3, again approximately. Interest costs from US treasuries, from US debt to GDP between 4 and 5% of GDP. Again, very high in the Czech Republic. It is now around 1% of GDP only. And approximately 20% of US tax revenues goes just on interest payments, which during the last 12 months, during the last year, interest costs surpassed $1 trillion. At the moment, 1.2 trillion. So I think this potential peak in the perception of U.S. exceptionalism also has something to do with foreign investors' realization that U.S. fiscal position is just simply not sustainable. And now with the Liberation Day and decoupling of the U.S. from the rest of the world, it's even more valid, this argument.
Okay. I am also interested, though, you keep circling back to what's going on in the U.S. and the risks that are there. What is the potential for Europe right now? If it's going to invest in itself, I think you even hear talk of say, governments not mandating that companies invest within Europe, but there is a real push to have Europeans invest in Europe, whether that's through, I don't know if it's going to be pension funds, if it's going to come down to that, but investing more and more into infrastructure, into its armaments. What sort of potential does that give for Europe? Will that by itself be enough, or do you think to really be any sort of long-term, say, competitor for the role of the primary currency, does it have to undergo further integration on a financial or legislative basis?
Yeah, definitely. Several things could help. European long-term structural supply-side growth. First of all, at least some unification of capital markets, financial markets. Firstly, second, the bureaucracy and administrative burden on European companies is really very, very significant, and it's growing almost every day. So some easing of regulatory legislative requirements driven by the European Commission, that would be helpful as well. And third, last but not least, more significant support also from the public funds to startups, to young, innovative companies. US has its Silicon Valley, and unfortunately, such a strong, innovative setup for young companies in Europe is, to some extent, unfortunately missing at the moment, in my opinion.